We are watching a little bit of weakness for North American stocks this morning. The TSX down about 0.1%. Touch more selling pressure in New York. And we talked about how after the big rally in November that some traders might be reassessing the road ahead on interest rates, which many have been betting would be on their way lower at some point in the near future. We got a Bank of Canada interest rate decision, by the way, tomorrow, although currently Bay Street doesn't expect rates to go down at that meeting. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity, to talk about the mood of the markets. Tony, nice to see you. I guess if we're trying to assess what investors are thinking of right now, what's your best guess?
There's just a state of confusion. I don't think anybody trusts a move that happens, John. And if you look at the volatility even within the sectors, I think it's been very difficult. So our call has been to what we call chillax, where we had such a surge off that initial move coming when the stage was set for a rally on October 27th. That move was so sharp, but when you look at it, including today, you're pretty much sideways for most of the indices, with a little bit of a bump in the small and mid cap area where there's a little bit of portfolio chasing into year end.
Okay, and so is that is it your view that because we had such a big run up that we shouldn't be surprised if things kind of just peter out from here on in through the end of the year?
It's what I would expect. So, John, here's what I have a problem with. If you go back to October 27th, the breakdown in the Russell 2000 was telling you that something was wrong. You know, if you're listening to quote unquote what the market is telling you, something was wrong. The move to 5% in the 10-year was telling you that there's going to be a resurgence of inflation. A month later, you've got the opposite true for both. So we're listening to a market that's quote unquote telling us something whose most recent call was horrifically bad. It's just very difficult until it is clear what the direction of the Fed is going to be. We need a significant and sustainable drop in rates, even from here, to really kickstart that improved outlook for money. So, you know, we had a pretty good trading call, I think, at the end of October. We neutralized it, and I think that's the place to be for the time being.
And then I guess if people are trying to figure out where we go in 2024, what are the variables to consider?
Well, the variable to consider is none of us have ever been right for the entire full year outlook. And I've been doing this for 30 years, and I think I've gotten it right once. And the reason is because you don't know where interest rates are going to be given the economic data that comes at you. So what our play is to be positioned properly, not just for the very near term, but also the intermediate term. And that intermediate term, again, looks like I'm having a hard time. Let's say there's a soft landing. That's not our call. As you know, our call is for a recession. Let's say there's a soft landing in the U.S. The important part of a soft landing isn't that it's a soft landing, it's that it kickstarts the next period of growth. That next period of growth has to come from something, and it's money. You have to have an improved outlook for money. In other words, mortgage rates have to drop significantly to kickstart housing. Corporate rates have to drop even more significantly to kickstart corporate borrowing. The IPO calendar and secondary calendar has to open up. There has to be some kind of increase in the money availability to get that next level of growth that will allow you to look through the weaker economic outlook. And we just don't have that yet. So I'm kind of light and tight where I've been for a while, X a couple of trading calls here and there.
Maybe you can just add a little bit of color on sector consideration. So this year we've seen a huge surge of money into technology, which was the big loser in 2022. Interest rate sensitive stocks have had their fair share of challenges. We were talking with a guest earlier about the interest rate sensitive REIT stocks. Dennis Mitchell, he thinks they'll do relatively well in 2024. But, you know, utilities have had a challenged year. You got financials kind of smack dab in the middle of this market, just sort of with, I would call it flat to positive performance overall. So if you're trying to position for the unknowns that you just highlighted, what goes into that thinking?
So our phrase that we've been using for the better part of the second half of the year is light and tight. And the light means a little less exposure, but tight to the benchmark, which means no major sector crazy outsized call. If the Fed gets more aggressive, which I think they will than anybody thinks, those interest sensitive areas and maybe even early cycle areas could do well. But we don't know that yet. So we've had this bounce in anticipation of what might come in a market that's been wrong on that. So, John, what I'd rather be is our most recent sector bias was to underweight the mega stocks, the Mag 7, and to not favor energy because it had such a nice run and it had become overpopulated. That's now been removed. So really, I don't want to make a big bet. There's times in the marketplace, people like me or Paige come on TV and make some kind of crazy big statement about what's going to happen. I don't really have a great flavor of what's going to happen, other than I believe there's going to be, the data shows there's going to be a recession. But when the banks were down 51% by the end of October and still down pretty significantly, and the Russell 2000, the small caps, were down 33% at the end of October, some of that is discounted. So we're in this weird position of defining the market of the big 7 or big 10 versus everything else.
Okay, well then let's go kind of to a side conversation and talk about how the market reacts or interprets messages, or maybe pushes messages to the side. And that kind of comes back to the rally that we saw in the face of some messaging from the U.S. Central Bank that, I mean, sure, some of it from some officials might have been perceived as dovish, but even going back to late last week, I think you could hear people on both sides make an argument for a bullish or bearish message from Jay Powell, or a hawkish or a dovish one. And Mohamed El-Erian was on Bloomberg Radio this morning, and he described the market as taking on the Fed on a variable that the Fed controls completely. Now, having watched a lot of market cycles over the year, what do you make of how the market is in some ways marching to its own drum? Does that feel like a new phenomenon to you?
I think we take data and we make stories out of it, frankly, because last July, the peak Fed funds rate was going to, not meaning July of 2022, the call by the market of what the Fed was going to do was have a peak Fed funds rate of 3%. So, did they lose control of it today because there's a difference in the market versus what the Fed is saying, or did they lose control of it in July of 2022? I just want to be careful that there's a lot of data that's coming at investors that is unclear and volatile. Typically, you get some kind of trend in the data. The worrisome thing is the whole bull story, and as you know, I'm typically a perma bull, right? I'm known as being pretty optimistic, and for the last 2 years, not so much. And the reason is because the outlook for money has not been there. And what you need to see, unfortunately, is a pretty meaningful uptick in the unemployment rate, because this I call it the zombie economy. You don't know if they're going to go into soft landing. You don't know if it's a hard landing. The data is mixed. You could have both sides supported. But ultimately, the only time that I can see where the Fed had a spike in rates, like it's never been this fast, but let's just say a spike in rates, there's only one time that you've gone higher for longer, and that was 1995. In 1995, for that soft landing, you're only halfway through the improvement in unemployment. In other words, you still had a significant improvement to come in the employment picture. We're at full employment turning the other way. You had the leading economic indicators significantly above where they are. So there's so many different facets of what's taking place now that would argue against that one time that it's happened, that we think there's still going to be a recession.
Okay.